Hello, this is Jordan, and this is your precious metals market update for Friday, April 25th. And the theme of this update is going to be that we're starting to see signs of inflation in a little bit in the economy, but especially in the markets. And so, starting off, this is a chart of commodities. This is the best commodity index, the CCI. This was the old CRB before they changed the weightings and really screwed it up, in my opinion. As you can see, this is a clear secular bull market that's going into its 13th year or so. The CCI has broken out of the downtrend, and that is a signal that the cyclical bear market, which lasted about 2.5 years from early 11 to the end of 2013, you could say, it's a sign that has ended. So this is a strong trend which looks to be back in bull territory. Secondly, one thing I like to look at is I also like to chart the CCI against foreign currencies, and I have that there at the top. UDN is an ETF, which is a foreign currency basket, and then below I just have the CCI. So this is a zoomed in look, and you really need to chart the CCI and also gold, which I'll get to later, against not just the US dollar, against foreign currencies. I mean, obviously the dollar is a big driver, but if it's only rising against the dollar, then what do you have? You have a dollar bear market and not a bull market in hard assets. So if you have a bull market in hard assets, they're going to be rising priced against not only the dollar but all currencies. So that's what we have here at the top, and you can see that's very close to having a big breakout. Looking at the bottom, you can see that the 400-day moving average was resistance in 2012, 2013. The CCI has moved above that. The moving average is starting to flatten, maybe starting to slope up a bit. In the top chart, we can see similar action, but the 400-day moving average looks to be a little bit behind. It's kind of starting to going flat, and then maybe in the next couple months it'll start to slope up. But we do see good confirmation there on top that this isn't just a commodity move. It's not just an inverse move against dollar weakness. Here's another chart where we have multiple things. At the top, we have commodities against U.S. Treasuries, and at the bottom, we have natural resource stocks against consumer staples. Now, the top, so we're looking at commodities against bonds. You can see commodities, the ratio is very strong in favor of commodities. It's broken out several months ago, and that looks to be close to a 2-year high. So that's very strong. You can see that ratio peaked in early 2008, bottomed at the end of the financial crisis, and then it peaked in early 2011. So it's another a good indicator of inflation or deflation, you could say. Now below, that's something that I got from Martin Pring. He's joining Stock Charts, and I saw him mention this yesterday. And so it's looking at natural resource stocks against consumer staples. That ratio has been fairly strong recently, but it hasn't quite broken out yet. It's very close to breaking out. If it does, again, that's a strong signal in favor of this new inflation trend reemerging. Now, next we have the best index for commodity stocks, which is $CRX on stockcharts.com. And at the bottom, we're looking at commodity stocks, that index against the S&P 500. Let's start with the top. Commodity stocks had a 65% decline, and then they had a really good recovery, but then they had a 33% decline in 2011. They've kind of been consolidating, or not consolidating, but really basing since that point. And the CRX has broken out in recent months. And it's actually close to a three-year high. We have my favorite long-term moving average, the 400-day moving average. We can see that starting to rise again, and that hasn't been rising, and the market hasn't been above a rising 400-day moving average since early 2011. So that's a very good sign that we could see a new bull move here. Is there anything else I want to mention? Yes. At the bottom, that ratio shows that commodity stocks very oversold against the overall equity market. They've been a huge underperformer. But that ratio, similar to what we showed you in the last slide, that's very close to breaking out. So a breakout there would be another very healthy sign and another strong indication that the markets are moving towards inflation. And the last point is that the CRX on top, I mean, this is a very bullish chart. The price action is very bullish because we had a big move up into 2008, then we had a crash. We had a big recovery, and then we've been consolidating that recovery. And so we're kind of looking at a potential cup and handle pattern developing here. So if we do get this inflation trend over the coming years, this is a very bullish chart that can move quite a bit higher, in my opinion. In contrast that with the stock market, which already had its big breakout. The stock market's been up for 5 years. This has been a tremendous bull market, but it's really long in the tooth. And you can see that another look at that is at the bottom, the ratio there. Commodity stocks, I mean, which would you rather own right now? I think it's fairly obvious. Now, let's get to precious metals. Let's get to the gold stocks. You know, I've seen a lot of commentary lately that the recent low could be setting up right shoulder for the stocks. We all know there's been this potential head and shoulders bottoming pattern. First, let me state I'm a huge long-term bull, you know, probably much bigger than anyone you know, especially on the stocks. But I don't think, I could be wrong, but I don't think that this low is the start of the next big move higher and we're going to get this big breakout. There's a couple reasons why. I'm not going to show everything because I'm going to talk about that in my premium service. But one thing is you have to look at how the gold and silver stocks are performing against the metals. I mean, that is your best indicator for looking at turning points. And we just don't see a lot of strength in the metals recently. Now, looking at GLD, it's apparently made a slightly higher low. But then I'm charting GDX against GLD, GDXJ, GLDX, which is the Explorers. Then on the bottom, I have the silver stocks against silver. I mean, 3 of those 4 charts are showing a negative divergence. If this was really going to be the start of the next big breakout move in this sector, you would see the stock showing a lot more strength. So this really gives me a lot of pause. Doesn't necessarily mean I think the sector is going to fall apart in the short term. I think there's more consolidating, more basing that has to happen. And I've showed this before to those on my email list of my subscribers, but again, you know, you really have to look at intermarket analysis. And on top, I have gold charted against that UDN, that foreign currency basket, and then on the bottom we have gold against the S&P 500. These are 2 charts that I'm watching very closely because I think if we get breakouts in these charts, that's really going to be a strong signal that the bear market is over and that we're headed for an excellent and sustainable recovery. And you can see on top, looking at gold against foreign currencies, it's just kind of been in the last couple months, hasn't really been doing much. You know, had a strong rise in March, or I should say it peaked in March, it's come back. I don't know what's going to happen. Maybe it holds here and breaks the line in a couple months. Maybe it moves lower and tests that low at 44. I don't know. I don't think it's going to happen in the next month or so. I just think we have to be patient. And looking at gold against the S&P 500, I mean, when the S&P really started moving aggressively to the upside, you know, late 2012 or early 2013, gold started falling apart. Money was coming out of gold. So this is clearly a very important ratio that we need to watch. And looking at that 0.75 looks to be the key level. That's where the market peaked in March. And so if we get above that, it would signal a higher high. And secondly, that 0.75 level was support going back to the second half of 2013 when precious metals started basing. They started this bottoming process, which has been ongoing for quite a while. So keep an eye on that level. And going back to what we talked about in the last slide, the miners they could telegraph these breakouts. So I don't think that these breakouts are going to happen immediately, as I've said before. But we could see the miners start to show more strength and get close to a breakout. That's the type of leading action that could signal that gold is ready to move and that these charts are ready to break out. So just a couple observations I just want to talk about. The one thing that listeners could point out is they could say, well, commodities are looking good, these charts are looking good, but why isn't gold moving? Study the 1976 bottom where gold got destroyed. Commodities corrected, but they held up much better than gold. And after that bottom, it was kind of the economy was picking up a little bit, and then inflation began to accelerate. Sometimes gold usually leads commodities when you have economic weakness, you're coming out of a recession, you have deflation is really the problem. That's when gold really is the first to sniff out the coming inflationary policy. Whereas when you kind of get a reflationary type move, commodities tend to be the leader of that, and then gold kind of lags, at least at the beginning of that. So that's something that we could be seeing right now with gold not confirming its bottom yet, whereas we see commodities as a whole look like they've bottomed. And we are starting to see signs of inflation in the markets and the economy. I mean, we've discussed the markets, but in the economy, just some news stories that I've seen. Wage growth in the U.S. has been the highest in 4 years. I just noticed a story from the BBC yesterday that CPI growth in Japan is at a 22-year high. In the U.S., the CPI and the PPI accelerated from February to March. Now, I'm not here to debate economics and what inflation really is and, printing money, et cetera, et cetera. This is stuff that traders care about. Wage growth, they care about these statistics. Traders in the big money, these are things that they follow. These are things that move markets. That's why we have to pay attention to them. Another story I saw recently, a couple weeks ago in the Wall Street Journal, the title was "Big Banks Ramp Up Business Lending." Subtitle: Increase Driven by Loosening Lending Standards. Now we know that a lot of this QE money has pushed up the corporate bond market, the equity market, but banks are sitting on a ton of cash that they haven't lent yet. So if they start lending, that's something that could push up inflation, and obviously the markets could already be sniffing that out, given what we've showed you here. And I mean, ultimately, a couple last observations. It really comes down, with respect to precious metals and secondarily commodities, negative real rates is the key. Now, bonds yields are actually dropping. I mean, I've been bullish on bonds for the last month or so. Yields are dropping, but if yields are going down and inflation is ticking up a little bit, then you have an increase in negative real rates. I mean, just compare what's been going on recently over the last 10 years or so with the 70s. I mean, in the 70s, we had very high interest rates, but we also had very high inflation. So interest rates were high, but the inflation was running much higher, so you had negative real rates. In the last 10, 15 years or so, statistically, we've had very low inflation. We know that's not the case, but statistically, we've had low inflation, very low, but we've had 0% interest rates. So it was the same as what happened in the 70s. We had negative real rates then, we have negative real rates now. And so if inflation is ticking up a bit and yields are coming down, and the Fed says, oh, we're not going to raise interest rates till 2016 or 2017 or whatever, the market knows that we're going to see stronger negative real interest rates. So, I mean, that could be what explains the strength in bonds and the strength in commodities. And lastly, I mean, given the debt problem and the debt crisis that we have, this long-term ongoing debt problem in the Western world, I mean, we need to have inflation. We need to have negative real rates. It's just, there's no way around getting out of this debt crisis. The economy is not going to accelerate or grow fast enough anytime soon. And if you study history, I mean, this is what happened in the mid 1940s to the early 1950s. Policymakers kept interest rates very, very low. Inflation exploded. I mean, we had wild swings in inflation in the 40s to the early 50s. And so rates were negative. Real rates were negative, I should say. That's what you need to get debt to GDP down, and that's what helps you mitigate the debt burden and get the debt burden down. So that's all I got for today. Thank you so much for listening. Check out my website, thedailygold.com. The top right box, you can sign up for my free newsletter where I post videos and other observations like this. And you can go to thedailygold.com/premium to consider my premium service. I don't think we've seen the next low yet in the gold stocks, but I definitely think it's coming at some point this summer, and I think the gold stocks are going to enter a raging bull market in the coming months, and that's what I focus on in my premium service. So again, thank you for watching today. If you have any feedback, you can email me, Jordan@thedailygold.com. Thanks so much for taking the time to listen today.